Singapore's flag carrier has outpaced its Malaysian counterpart by a wide margin in recent results. In the year to March 2024, Singapore Airlines, SIA, reported a record net profit of 2.68 billion Singapore dollars, whereas Malaysia Airlines' parent, Malaysia Aviation Group, MAG, earned only 54 million Malaysian ringgit, about $12 million in 2024. But why is this the case? Well, let's take a look at the financial performance of each company using financial metrics. Revenue. In fiscal year 2024/2025, ended March 2025, SIA Group earned 19.54 billion Singapore dollars, up 2.8% year-on-year to a record level. By contrast, MAG's full year 2024 revenue was only 13.68 billion ringgit, about 4.3 billion Singapore dollars. SIA's travel and cargo business is roughly 4 times larger. Net profit. SIA's net profit in FY 2024/25 was a record $2.778 billion, up 3.9% year-on-year, aided by a $1.098 billion accounting gain. MAG's 2024 net profit was 54 million ringgit, about $12 million, a 93% collapse from 2023. On an operating profit basis, SIA made 1.709 billion Singapore dollars versus MAG's only 113 million Malaysian ringgit. Passengers. SIA and Scoot carried 39.4 million passengers in fiscal year 2024/25, up 8.1%. Malaysia Airlines, mainline and regional affiliates, served about 16.6 million in 2024. Load factors and yields. SIA filled 86.6% of seats on average, among the highest in the industry, whereas MAG's load factor was about 80%. SIA's average fare, yield, fell to 0.103 Singapore dollars per revenue passenger kilometre, down 5.5% year-over-year, while MAG's yield averaged 30.1 sen Malaysian ringgit, about 0.086 Singapore dollars per revenue passenger kilometre, down about 10%. In other words, SIA was able to charge roughly 20% more per mile than MAS. Cargo. SIA's strong cargo division gave it an edge. In the third quarter of fiscal year 2024/2025, SIA's cargo revenue grew 9.7% year-over-year, helping double its quarterly profit. MAG's cargo arm, MAS Cargo, also improved load factors in 2024, but on a much smaller scale. To put these statistics into simplicity, SIA's total revenue and profits were several times those of MAS, reflecting its larger scale and higher average fares. Singapore Airlines also reported an even higher profit, whereas MAG's 2024 profits dived from 766 million ringgit to only 54 million ringgit. The key drivers are clear. SIA saw surging demand and cargo lift, plus a one-time merger gain, while MAS suffered lower fares and cut capacity amid maintenance delays. But why is this the case? We can't simply assume that it's all because of cargo and demand, right? Well, one answer can be because Singapore Airlines operates a much larger and more modern fleet tailored for premium, long-haul travel. As of March 2025, the SIA Group had 205 aircraft with an average age of just 7 years, 8 months. This includes dozens of new Airbus A350s and Boeing 787 Dreamliners, along with 12 double-decker A380s and 22 Boeing 737-30ERs in its passenger fleet. SIA added the latest jets to expand its network. As of May 2025, it even had 78 aircraft on order. The group serves 128 global destinations, 79 via SIA plus 71 via Scoot, leveraging hub Changi Airport to connect Asia with Europe, North America, Australia, and beyond. By contrast, Malaysia Airlines' fleet is smaller and older, geared more to regional markets. Before 2025, it had roughly 80 aircraft, mainly Airbus A330s and Boeing 737s, serving around 67 destinations, about two-thirds the number of SIA. For example, in 2022, MAS operated 9 A330-200s and 15 A330-300s average ages over 10 years, plus 1 A350-900 in 2020, 44 Boeing 737-800s. More jets are on order for MAS, including new A330neo and Boeing 737 MAX types. By fleet size, it's about one-third of SIA's, SIA Scoot 205 versus MAS, approximately 80. This gap means SIA can offer far more flights and frequencies. Changi alone rivals KL as a transit hub. By 2024, Kuala Lumpur International Airport hosted 73 foreign carriers and 138 international routes, an improving connectivity picture. But Singapore's hub remains busier and better connected across the Pacific and Atlantic. Aircraft utilization patterns differ too. SIA can fly larger jets fully loaded, including to high-yield routes. Scoot adds to capacity on dense, short-haul, 53 narrow-bodies in 2025. MS primarily serves Southeast Asian and South Asian city pairs, plus a handful of long hauls, London, Australia, etc., often in competition with low-cost carriers. Even the cargo networks reflect this. SIA's cargo serves 132 destinations and has captured e-commerce demand. MAS does offer cargo via Maze Cargo, but on a far smaller scale and with an older fleet. In sum, fleet and network strategy favour SIA's efficiency and breadth. Singapore Airlines invests in fuel-efficient wide-bodies, A350, 787, and keeps its planes young, enabling high aircraft utilization and lower unit costs. Malaysia Airlines, working through MAG and its Firefly subsidiary, has only recently begun modernizing its fleet, e.g. ordering A330neos and more 737 MAX jets, and still relies on aging A330s. An older fleet can mean higher fuel burn and maintenance costs. Moreover, SIA's global route map, Asia, Europe, US, Africa, contrasts with MAS's largely Asia-Pacific network. This scale and modernity gives SIA a commercial edge in filling premium cabins and carrying profitable cargo, whereas MAS's smaller network limits its revenue base. Secondly, one must also know that Singapore Airlines is widely regarded as a premium five-star airline, while Malaysia Airlines is seen as more of a mass-market carrier. Industry awards highlight this gap. In the 2024 Skytrax World Airline Awards, Singapore Airlines ranked second in the world, winning Asia's Best Airline and Best First Class, while Malaysia Airlines was ranked only around 39th globally. This reflects SIA's emphasis on service excellence and in-flight product. For example, SIA recently committed $1.1 billion to overhaul its cabins, installing brand-new first-class suites on 7 ultra-long-haul A350-900 ULR aircraft. Thirdly, there's also the fact that Singapore Airlines and Malaysia Airlines have different market strategies. SIA has a clear two-tier model. Its flagship full-service carrier, SIA, focuses on long-haul premium markets, supplemented by Scoot as a separate low-cost unit for short-haul leisure row. This allows SIA to capture high-yield business and first-class traffic, for example Asia-Europe and Asia-US corridors, and hedge it with the steady volume of budget leisure traffic via Scoot. SIA also has cargo and cargo joint ventures, like Cargo Lux Partnership, to round out revenue. Its strategy exploits Singapore's strategic hub location and stable regulatory environment. Malaysia Airlines, MAG, historically followed a more hybrid model, covering both premium and budget markets under one umbrella. In the past, MAG even briefly partnered with AirAsia to cover low-cost routes, before shifting again. By 2012, as Caper noted, MAS refocused on premium travel and spun off low-cost operations. Finally, external trends have affected both carriers, but SIA has often turned them to its advantage. Fuel prices and currency moves are industry-wide headwinds. In fiscal year 2024/2025, SIA's fuel expense rose by about 6%, $309 million, due to higher volume, but this was mostly offset by an 8.5% drop in fuel prices. SIA also hedged fuel early, limiting its exposure. Malaysia Airlines similarly faced fuel cost swings. In fact, the group was cautious about 2024 due to forex fuel price challenges. Both airlines passed on some fuel cost via surcharges, but older planes, as in MAS's fleet, can burn more fuel per seat kilometre, squeezing margins more than for newer aircraft. The COVID-19 recovery has been a boon for travel generally. SIA capitalised on pent-up demand in long-haul markets as borders reopened. By mid-2024, SIA reported healthy bookings and cargo lift. Malaysia Airlines also saw passenger numbers rise, 16.6 million in 2024 versus 14.5 million in 2023, with load factor improving from 77% to 80%. However, timing and segments differed. SIA recovered first in lucrative business routes, e.g., to North Asia, Europe, whereas MAS had more leisure and regional exposure. Moreover, MAS's travel rebound was hampered by the late 2024 capacity cut and maintenance delays, whereas SIA did not face a comparable shutdown. Singapore Airlines has outperformed Malaysia Airlines in 2024/25, mainly due to scale, strategic focus, and operational strength. Financially, SIA's record revenues and profits dwarf MAG's results. This gap stems from SIA's ability to command higher yields in premium markets and monetize a broader network, compared to MAS's more price-sensitive, capacity-constrained model. SIA's investment in fuel-efficient jets and expanding cargo operations has boosted productivity, while Malaysia Airlines' older fleet and safety-related cuts have limited its output. But anyway, do let us know what you think. Thanks for watching.